Yeah. So thanks, Marty. I wish I was there with you guys in Miami. It's one of my favorite places. And Sal and Mario, I wish I were there with you. Peter, nice to meet you. Where are you located, Peter?
I'm actually born and raised in New York, but I've been living in England, in Mayfair and Wimbledon for the last 22 years. So I haven't given up my New York accent. And this time of year, I'm usually at our Basel, but I'm visiting my parents and family in New York for the holidays. So I decided to stay here.
Great. Well, welcome. So yeah, I guess, Peter, why don't you start off telling us a little bit about yourself?
Sure. So as I started out, was born and raised in New York. I've been living in London for about 22 years. I started my career in the late 80s at JP Morgan, then moved to Salomon Brothers. Over the last 7 years, I've been running a multi-billion-dollar multifamily office out of London and Denmark. Originated about $12 billion in the last 18 months in various financings for real estate, metals and mining, and other assets. And just recently, actually, I left the family office and now I'm an operating partner at BC Partners, the leading and oldest LBO firm based in London. So I'm based in London, in Mayfair, but I spend a good deal of time here in the States as well. And our focus is pretty much, we do three things. One, we look after a lot of large family offices, investments, as well as pensions and sovereign wealth. Given that's my background, I spent a lot of time looking at real estate investments across all asset classes. We looked at crypto. We look at telecommunications, media, and technology. We also do something that's quite interesting. We do what we call GP NAV lending. We will lend to small, mid-sized private equity firms and family offices that operate as small private equity funds and give them leverage at relatively attractive rates should they want to do bolt-on acquisitions or acquisitions, and they're basically short of liquidity. So we can provide liquidity in an environment that we're actually looking at right now, where it's becoming more and more difficult to get access to stable sources of funds as the banks kind of dry up, and the only other options are alternative credit lenders or private equity at relatively high rates. So we're able to provide, depending on the risk return profile. We also own an insurance company, so we're able to provide pretty good financing, either secured against the portfolio companies that a family office owns, or again, a private equity fund that's small and mid-size. And we could, again, lend against the various portfolio companies or investments they have, or we could take a promote or share a promote there. So hopefully that gives you good insight on what we're doing.
Yeah. Do you do that in the US or just Europe? Or
No. So we are Western Europe and US focused. I do a bunch of investments in hospitality in the Caribbean as well.
Great. And the firm you're with currently, do you consider that a multifamily office, or are you investment banking, or what do you do?
No, so I've been working for the last 7 years as running a multi-billion-dollar multifamily office out of London and Denmark. I currently just moved a couple months ago to BC Partners, which is a private equity firm. It's the oldest private equity firm in Western Europe. And again, we have a lot of investors in the fund and come from a family office perspective as well. So
Got it.
Hopefully that helps.
Perfect. All right. Mario, sorry. Do you want to go next? Tell us about your family and what you're doing.
Marco,
I'm sorry.
Look back.
Mario, come on.
Yeah, you were looking around
for Luigi, too.
for Mario. Sorry.
There's about 5 guys in the room named Mario, so it's not a problem. Come on, Mario.
Come from family office, family corporation, really. Born in 1903. We were the pioneers of car racing.
1903.
My great grandfather started this company.
This is already starting off.
Yeah. We haven't even hit drinks yet. So today we're, yeah.
Say, speak for yourself.
So it's the pioneers of engineering in this, among other families like Ford, Chrysler, Cadillac in the world, but based out of Europe mostly. Cars, aviation, boating, and motorcycling, two-wheel sector. Today we rebirthed this and we're taking the transition that everyone in the sector is doing, which is the electric vehicles, hydrogen cell fuels, and any type of technological adaptation to increase optimization of the businesses. So AI, there's a crypto NFT metaverse play on this as well. And the other part of that is real estate.
Do you take outside money in your businesses, or is it just a family business?
No, typically it's just our own money. Very rarely anybody who is intermarriage within the family with a different surname would participate, but we maintain board seats majority with family members only.
And
Got
that's to
it.
keep the legacy, right?
That's for the legacy
Okay.
purpose.
Sure.
So
Sure.
anything we touch today will have to have our surname on it.
Got it. So you really are direct investing.
Yes.
Okay.
Yes. So if I
Sal?
invest in it here, it'll change the name.
You primarily, you have to take control.
No, not necessarily control. It's not for control purposes, but the brand itself has value, and I believe in brand equity, and hence we put money. We can take a minority stake, but we would take a board seat if it's a giving company that is offering. But once again, it's the brand equity value that it's the best. And it's like Rockefeller putting money into any of your companies. You want the Rockefeller name somewhere in your halls, right?
It's legitimate.
So you're lending your family name to the business?
It's not lending, it's licensing in a way, or franchising it. So a lot of the businesses that we have, specifically when we work with distributors or concessionaires around the world, it would fall under a franchise agreement the same way McDonald's, which is a well-known corporation, would do it worldwide when they start expanding.
Got it.
Yeah.
Okay, thanks. Sal, did you want to?
George,
Tell us
it's a
about
pleasure and a
yourself.
privilege again to be
Good to
hosted
see
by
you.
you. Last time I was in Dallas. My name is Sal Buscemi. I've been following Marty for about 20 years. Like the Grateful Dead, we found tremendous amount of deal flow from him since leaving Goldman. And I started actually Dandrew Partners 20 years ago under basically a nomenclative homage to my maternal grandfather, who was the president of American Hotels Association and was a hotelier. My career was in real estate at Goldman Sachs. After leaving that, I raised 2 institutional funds under the Dandrew name.
Cheating.
And since then, no, I wrote some notes, but what I noticed during the time,
You know, he
stop treating me like a president, right? Anyway. So other things I write are books. Marco's actually in one of my books too, Investing Legacy, where we talk a lot about, the family offices and there are a lot of people here who would probably really appreciate that. We about 2 years ago, and during the pandemic, we came together because I was making a lot of principal direct investments, mostly because of Marty sending people out to Vegas, because I was this crazy guy who had just had some exits in real estate and was making life science investments. And after talking to one of our CEOs, it came to the conclusion that it was very easy for us to move into doing a lot of the healthcare stuff, because a lot of these real estate families have philanthropic arms, and that's the gateway drug to a lot of these life science investments. And usually that's disguised as poorly allocated into organizations with materially high expense ratios, to put it politically correct. And then they find out later that all their money is not going to where it is. And you have someone on TV dripping in pearls and diamonds and gold. And it's like, hey, I thought I was helping cure cancer, but it's not the case. So that's how HRN was put together. And it was put together because of the experiences that my 2 partners have in life sciences, Albert Ewan, CFA, who managed $6 billion for the Rockefellers in life sciences, and also Bill Workmister, who at the age of 26 was managing for the state of New York and the state of Texas, their venture capital funds, especially as related to life sciences. So there's a comfort there where you start to see that we're able to go from one pocket into the other through way of the philanthropies. And the companies that we've invested into are world-class, and they all have 3 things in common. They're headed by world-class CEOs who have multiple exits. They have stop cheating. And they have, honestly, they've had multiple exits, but they're also led by formidable families too as well, meaning families that are best in class. If you take Thrive, for example, one of our latest investments, and all our CEOs we love like our children, but some are more special than others. Tom is, I shouldn't say that, but Tom is one of them. And Thrive, we really like that. And our families have a level of comfort there because you have to remember, they're not life science guys looking at the data. They're looking at the story behind it. And when you have the story such as Tom, and you have other companies that we've been into with people who have many exits, and it makes a lot of sense, it really compels these families to look at impact more as something that they can follow along as a narrative that they want to be involved in, rather than being pitched something with a lot of data. The companies we've been invested into has been Immunicom. We got into that at a $5 million valuation in 2016. It's currently appraised at 375. Genius Biotechnology, led by Alfred Slanis, who brought Bluebird Bio from near bankruptcy to $1 billion exit. 25 Madison is what we used to kick off the company with, because it started by a former Goldman partner who was a boss who remembered me, and we wanted to make an investment in that alongside Apollo. SciTech Development, AI Scout, which was headed by Raptor. That is probably the most prolific use of AI that I've ever seen, where you're actually, it's for recruiters, because it's very inefficient for them to be able to recruit people and players around the world. And they have Raptor, which is of the FanDuel and of the, the Fanatics exits and all of that. Thrive, and then most recently we have another one that's coming up and headed by, I forgot to mention Apricity Health, but there is a roll down called Bectus Pharmaceuticals that we'll be talking about in January. And that is, and if you want to hear about that, we're actually doing a closed door Zoom with Dr. Jim Allison this Thursday, very closed door at 2 p.m. Eastern. You can send me, he is a Nobel Prize winner and the co-CEO, 2018 Nobel Prize laureate for oncology. And he has his whole Amazon documentary, and he's going to be fielding questions from our families who are, going to be introduced to him for the first time. You can email me at sal@hrn.llc. I've also written 3 books. I'm a contributor to Entrepreneur and do all sorts of other things. But anyway, I'm here with my fratello minore over here, Marco, and this is going to be one hell of a session. I can promise you that.
He's selling.
You want to say your book, you need to include.
I'm a salesman.
We're going to give him the link to the Amazon. All right.
Well, thanks, Sal.
Thank you, George.
That was the whole hour.
All right.
Not quite.
We can go to the bar now.
All right. Sounds like you guys already have, but anyway, how many families do you typically work with?
Me, right now, we're working with 10 large families, and those have been the ones that have been our, they have gone into every just about life science deal from the last real estate deal we've done. And we've built a hell of a reputation with them. And it was because we were able to leverage the reputational equity we had in real estate into these things, but we were also showing them, look, you consider me best in class. You should see, these CEOs like Tom and everyone else that we're showcasing.
In our case, we co-invest usually with other families. That's typically how we do it. Maybe about five families that are very close to us.
Got it.
Yeah.
So I know on the last panel, multifamily office, kind of people bandy that name around a lot. And there was some doubt on the last panel about what is a multifamily office, or if there really is such a thing. I, for one, have a number of clients who I do consider multifamily offices. And those are families that don't have enough wealth or the desire to hire an internal staff. And so they outsource the CIO role to a multifamily office that is a registered investment advisor that does have the investment expertise. And yes, they may not have all the resources of a big bank, but they have more resources than a single family would, hiring their own chief investment officer. So, I mean, it sounds like you guys fall into that category as a multifamily office.
Who are you talking to?
You're talking to me?
Well, both of you, if you co-invest with different families. I mean, particularly you, Sal, if you have a group.
Yeah,
of
I
More
think
you.
it comes down to the structure. I think the term multifamily office has sort of been abused, and it's really sometimes broker dealers and drag, right? And it's like,
Right,
you know, if you don't like what's in my left pocket, I'm going to show you what's in my right pocket.
right,
I think a real family office, as a, you know, we talk about this in the State of the Union, where you have a you know, direct allocation structure where the families can participate. And you know, we use a master series LLC, but I think if you give them the discretion to be able to invest, it makes a tremendous amount of difference. And that solves a lot of the problems because those are principal investments and they're looked at. And so there's responsibility as an investment manager for due diligence and things like that.
right.
Marco?
I mean, from our perspective, what we'd like to do is cut out a block for family offices that are in a different wealth bracket, that are good friends of mine, and typically they would invest in me for me being behind the deal and me putting skin on the game. And typically we do the majority of the block. So that
Got it.
kind of speaks for itself.
And if I could just jump in, George, and just agree with Sal, in my last role, you know, coming from a multi-billion-dollar multifamily office, we basically had 5 families. Each was a billionaire family, and either all of us would invest together, or maybe just one family would invest, depending on what the asset allocation was related to. But in many of the cases, it's a very small community in terms of the family offices, particularly in Western Europe, but even among some of the ones that I work with in the States. And so we might have one investment where one of the families it's a single family office, and they're the experts in a particular area. But then we'll bring in or syndicate, and not like a bank syndication from Goldman, where
Right.
it's around like a broker, but we'll syndicate to maybe 2 or 3 of our close friends that are familiar with the asset. So let's say it's a sports team. We might be the leading person with knowledge and seeing most of the sports teams that cross our desk, but then we will ask a few of our friends that have invested alongside of us in the past if they'd like to come in, and we can make a larger bid if we're looking to take a controlling position or even in a minority position in something in a particular club. So you know, just to give you an example, so you have a true multifamily office like you mentioned, George, where it's basically just a platform where many smaller family offices come together, invest, and don't know each other. It's no different than investing in an asset manager that has many LPs, or it could be just a syndicate of a bunch of family offices that know each other quite well, or it could be a much more formal structure like the structure that I came from. So those are kind of 3, I think, different ways to look at it.
That makes a lot of sense. And yeah, in Dallas, for example, there are a lot of very wealthy families that do real estate syndications and all invest together. There are some that do private equity direct investing, which is a little more unusual, but those are the larger family offices that have a large staff to do the due diligence and can pay to hire outside counsel. But yeah, I agree. The term multifamily office gets thrown around a lot and means different things to different people.
But this panel is basically direct investment. So, you know, we looked at it. Our competitors were the Goldmans of the world. Our competitors were the bigger, large family offices. You know, our minimum size was 150 million. We could either easily go with, if we brought in some other families, to north of $1 billion. So the reality is we were a private equity firm, basically called the multi-family office for all intents.
That's it. Yep.
Hey, George, it's Marty. I got so you have Fraser McCombs, which is a fantastic consortium of like 5 billionaire, you know, into a private equity fund structure looking at auto, right? And in Texas.
Right.
And I think is it Sentinel Trust? It's kind of like an organization, a family office that's a not-for-profit fiduciary. Is that correct?
Right.
So you have some fantastic organizations in Texas, which I think are kind of leaders in this space. And I think, you know, and obviously here in Florida, you've got this Palm Beach Investment Research Group, which is 35 family offices who have joined together to share analysis and due diligence, right? So they may co-invest with each other, but I think that's where Peter was coming from. He has his 5 families, and they all looked at deals together, and not necessarily did they have to invest, right? And I think Sal is in that same place.
Yeah.
With the stuff he puts forward. So
Yeah, and I have to backstop it too.
yeah, I mean, what you vouch for, that's extremely
It's a
meaningful.
big deal.
Yeah.
It's a
Sure.
big deal. And there's actually other forums out there that make it more granular. It's like the Caresu forum, right? I mean, that's
Sure,
one of the, they sort of, democratize it on, but more people, not by families, but it's a similar construct out there. Really what it is a sense of community.
Right. And so you like to, instead of being a multi-family office where the families don't know each other, you like to bring in families that do know each other.
I usually call my same friends. I mean, I got 5 guys that I call, and that's about it. If I meet someone that I really like, then I would consider it. But it takes time to build a relationship.
Yeah, and you know what?
Remember your cap table, especially in Europe, for the gentleman that lives in Europe, we pay attention to the cap table and see the names on who is involved in the deal, because then we know who's influencing the company's operations in order to make it successful.
Right.
Here in the US, I don't think that's so much the case. You'll have a cap table of 40, 50 people, and that's just too much, too many.
Right.
So I pay attention to these things, especially when I invest in deals.
To follow up on that, I have a rule when making venture capital investments is that the cap table is the soul of the asset, but the board is the company's conscience. And if you look at it that way, you're going to be a little more discerning as to who you're getting into bed with these investors. And I wanted to see in class or better.
You wrote that in your book, right?
I did. Yes. Thank you. That's available on Amazon.
You memorized that line.
We can post the link later.
That's okay.
The word, it's all sold out.
It's all sold out.
There you go.
That's
right.
Marty got one. I don't know who got the other.
Yeah.
You have a question, you said?
Yeah, so general question is, I'm curious, we all see a lot of deal flow, curious how you guys get the deal flow. Just a few examples I mentioned earlier today, we work with DARPA, I'll be with them next Wednesday. There's a lot of work in autonomous vehicles. We would love to connect with someone like you guys, for Sal, I believe, someone like Michael that's working on university IP or doing other things. The gentleman that spoke yesterday on obesity seemed like amazing. Excited that you're working with Thrive. I think they're doing some good things.
Yeah.
How are you guys getting your deal flow through these kind of events or?
Well, yeah, for me, it's coming. I mean, as I said before, Marty got me sort of the gateway drug into life sciences with a few deals and sending people out over the years to Vegas to see this crazy guy. And it was I'll tell you what it is. It's a certainty of execution that really builds the relationships, because remember, this isn't a transactional business, it's a relational business. And the fact that I'm able to bring real estate people into life sciences to some seem like an alchemy compared to water to wine. And what you've seen now is that a lot of life science investing are now going to cross-pollinate into real estate when the time comes. And that's how you really build a relationship in a family office, where there's a lot of trust around that, because you're dealing with best-in-class operators, entrepreneurs, or CEOs.
We work with like Mount Sinai and other hospital systems that obviously would be interested in working with more family offices. So, things like that. It's I think it'd be a lot.
I have not seen Martin in years.
It has been years. There was that polo party.
We've been in touch. I travel very often, and I happen to be in Miami.
He was divorced.
And he asked me, and I said yes. But yes, deal flow could come out of this for sure.
Yeah, and it's reputational, because if you see people know that you're going to write it, there's a lot of people out there that say they write checks and they don't.
Right.
You want to suck the air out of them, write a check, because then your name goes all over the place. Yeah.
Peter, do you want to follow up on that as far as how you get deal flow? And I guess what are you looking at these days as far as asset classes or industries?
So I guess it's a 3-pronged question for me now. Number one, real estate has always been a core strategy, one of the largest strategies for large family offices. That's interesting, but I think over the last, I would say, 5 to 10 years within the real estate space, it's branched out to logistics, data centers, others. They've been co-invests with people that are smarter in the space, etc. So there's a number of places. In the real estate space, we've gone to fintech, so focused on green tech, clean tech, and all the associated bells and whistles that if your Lexus or BMW has more data on you than your home, or a residential or office real estate project, that's a problem. Because if your hotel room shouldn't have cams in it to see what you and your partner's doing, but it should have enough things in the wall to understand if somebody falls down, they're hurt, etc. Call an ambulance. So there needs to be a better technology to keep track of data in real estate. So again, green tech, clean tech's been more important. So that's the real estate version. In terms of more direct investments, as I mentioned, I take a private equity approach to the investments, and I can invest across the capital stack. But we're typically looking for IRRs that are in the mid to high teens. And that's very important right now, if you think about it. If you could buy debt right now that's investment grade or crossover and get it at 80 cents on the dollar, 85 cents on the dollar, even lower, that traded at par a few months ago, why would you do a private debt or private equity investment that's going to give you the same type of yield in the low to mid teens that's completely illiquid and you have to sit on it for a while? So right now, I think there's a fundamental shift going on, and it's a shift where you're competing both the larger family offices and the private credit funds or alternative asset managers, and just buying publicly traded securities that are trading at a discount, that are very large and liquid, and you could basically then just flip it to one of the investment banks if needed to provide the liquidity, than being stuck in an illiquid transaction, whether that's real estate, private debt, or private equity. However, as we go back to the 2008 global financial crisis, the beginning of the pandemic, that window closes extremely quickly, particularly when we're talking about a recession or a normal economic cycle like we're going through now. That window will close pretty soon as basically smart investors, smart capital comes and sees where the fundamental value are in these particular publicly traded securities, which takes us then back to private debt, private equity investments. And so where are we sourcing deals? We're sourcing deals from consultants. We're sourcing deals from the larger banks. We're going to basically see a cycle now. So we'll see a lot of distress. So we'll probably see stuff from the boutique advisory firms, the larger firms like the Houlihan Lokis and the Molises and stuff that will call on us. And then again, because of size, we'll team up with other friends and family that we know, and we will share investment theses and stuff. And the whole is greater than necessarily some of the parts. So we will do that as well. But also, I think, and I'll leave on this, it's very important. We are looking at different areas that are uncorrelated to equity, debt, and commodity markets. So what does that necessarily mean? We'll look at litigation funding. We'll look at this GP NAV lending secured by the portfolio companies within a family office or a small to mid-sized private equity firm. We'll look at life sciences. We'll look at fintech. We'll look at other industry spaces that are not well covered, where we could be much smarter on that. And we're willing to take a 5 to 7 year type of framework to look at it. So I think that's very important as well. We don't need to be a controlling position. Again, if we're doing it from a credit fund point of view, we're not looking to necessarily take a controlling interest, but we can be impactful. And I want to highlight impactful within a minority interest or some, because we can help management to affect change, not an activist strategy, simply by leveraging our deep bench of contacts within the various industries we're looking at. And I think that's something that we were just speaking about just a little while ago with Sal in terms of his expertise and his friends in the life science businesses. So we'll want to partner with somebody like him in his family office or some of his several families. And again, not be an expert there, be more passive, but learn from them and hopefully share ideas. And together we become much more stronger.
There's also, just if I can interrupt, speed matters today. And we purposely structured legally our family office structure to use a master series LLC, because there's going to be a phone call that comes in, and we did it with AI Scout. Hey, we need $1 million. So there's opportunities for high, MOIC to be able to move in quickly and decisively. And that's really what, speed and execution really, if you're following all the parameters and diligence, of course, that's where families today make the most impact, is to be able to move and be very agile. You have to have the structure for it.
So Sal, just to be put a fine point on that, do you have a dedicated fund? I know you say you have a master LLC. Do you have commitments, hard commitments from investors?
No, everything's hard. So when it goes out, everything has to be, so we didn't use your firm, we used Perkins Coie, but everything's structured. Sorry, I didn't know you then.
No
George, but
offense,
yeah.
George.
That's quite all right.
All right, I mean, yeah, but yeah, I mean,
He'll use you one day.
yeah, one
Good.
day. No, it will be.
When you have a deal in Dallas, please.
We have it structured so that this is the commitment you have to.
We
fund it
like all the
within-
books you have behind you.
without, within 30 days. This isn't something where it's like like any other fund or, where there's got to be some sort of commitments or hurdles or, a pledge fund or anything like that, because that doesn't really help us. And that sort of, I think, destroys reputations with entrepreneurs. Because if you come to the point and it's like, hey, I said I'd have $1 million, but I only have 100,000 because, for whatever reason, we don't want any of that. So everything goes hard. And we outlined the boundaries of the relationships with our families earlier on. I wrote a book about that, but joking aside,
That's another book.
they know what to expect. And I think that's really what it is. If you look at a lot of the families today, west of the Mississippi, they don't really have the same construct structurally as the ones east of the Mississippi, if that makes sense. So they're sort of emerging. I call them emerging families. They're over 100 million, but they're still kind of emerging. And that's what they rely on us for, that type of leadership.
Got it. Peter, do you guys have a dedicated fund or you form a SPV for each investment?
Well, just remember where I'm sitting. So previously, I was at a multifamily
Right.
$1 billion family office. So let me address that. Right now, I'm sitting at a private credit / private equity fund. So it's obviously a very different structure than relevant to this panel. But nonetheless, all we do is private direct investments on
Got
the
it.
credit side and then the private equity side. So on the family office side, since I was key there, again, each investment would be set up with a specific SPV or LLC to that. And the families would invest whatever their allocation would be into the particular fund, you might say, or SPV vehicle that was set up. Very simple structure, you might say.
Right. But at your current position, if you're a private equity fund, obviously you have the fund, but do you also offer direct co-investments to your investors?
Yeah, so BC Partners is, again, one of the largest, one of the oldest LBO firms in Western Europe and the US. So you have a separate situation with private equity with various funds there. And then at the credit fund side, there's 3 funds. The first fund was a special opportunity fund, lost about 7 years ago. Another special opportunities fund that was launched a few years back, $1 billion. We're currently raising another fund. And so we will have SMAs alongside of the larger fund that you might say that's investing. So if that helps to answer the question. So we can do smaller managed accounts alongside the larger fund.
Right. But I'm saying, obviously the fund is a blind pool, but if an investment comes up and the fund doesn't, or the SMA doesn't have enough money for it, do you pass the hat and create a co-investment vehicle to invest alongside the fund in a particular investment?
That I don't have the answer for. I'm too new to the firm.
Got it.
Back to you on that.
Okay, sorry. Yeah, I think that's a fairly attractive thing for family offices to be able to invest directly alongside a private equity firm, whether or not they're part of the fund itself. Marty, I see we have a question from Christine, and I'll read the question. Might need some clarification. It says, what do families want when investing in a company beyond financials and data, and why would that be? Anybody want to take a stab at that, or Marty, could you put some clarification?
Yeah, I'd like to have Christine, if Christine can clarify at what stage, because I think that was a topic of conversation yesterday with Tim Draper, was that, at very early stage, you're really looking at intangibles, and at the later stages, you're looking at performance, right? So
True. Yeah. So again, for example, in the most recent acquisition we did was of a telecom company based out of Europe. What we were looking at with this telecom company was what kind of contracts they had, short-term versus long-term, in order to create value on the company. And we ended up buying 80% of the company from a very highly influential person whom I convinced to stay on board because he was really the person that everybody knew in the business. And so that was the way it was structured from that point of view. So we're looking at that from that perspective. Then we realized that a lot of those contracts were not good contracts. And then we obviously had to know who was the law firm that was advising you on drafting this contract. So now we have to redo them, and it's so when you dig in companies and even if they have a revenue source, take a very close look at what those contracts they have look like, because they can affect the future of the company after post-acquisition, post-investment. And that's something we learned a little bit the hard way, but we did a very extensive due diligence, which, as you guys know, take a long time. So it took us like 60-90 days to finalize the offer, and now we're the owner of a telecom company, the fourth largest in Italy right now.
I think I'll answer this just from the life sciences standpoint, because real estate is very easy to sell and it's boring. But earlier stage, I think with life sciences, it's important for the CEOs to get branded very soon. A lot of them are very smart, but they try to mask themselves or their brand behind data. And unless you're like Dr. Jim Allison, who won the Nobel Prize in 2018 in oncology, that's very difficult to do. And if you look at what families are looking for, they're not so much looking for financial, they understand financial risk, but they don't want to have any sort of headline risk. And I was once speaking at an IMN conference about 3 years ago before the pandemic, and some guy like Marco asked me what the definition of risk was. And the definition of risk is what your friends and family are going to laugh at you for.
Another Marco.
Another Marco.
Another
Marco.
Okay.
Yeah, that was Mario. That was Mario then. That was Mario. Anyway, and it's what your friends and family will make fun of you for if the deal goes bad. So in order to do that, we have to put together a story where we showcase the important points. Using Tom as an example, he's had 7 unicorns. If you were to look at his bio on his website, it looked like a tombstone, like a bunch of company names. It was very, very inconsequential. But people, and this is the key point, especially if you're raising capital, nobody wants to go through high school biology and chemistry class anymore, right? So what you have to do is you have to put them in, you're laughing because it's true. See, my man knows this over here. And what you have to do is you have to put together a story today because it's a narrative that's important. And if you have the opportunity so that all of the people, your CEOs or your investors, go to their friends and say, look at the company I'm invested into, right? This guy, that to them is an elevation of status and legitimacy that they're not going to find elsewhere. And that's really what needs to be done. And another example of this would be Peloton, which went, the whole stock did a horseshoe, but people knew Peloton, right? The secondaries were trading very high before the IPO. It was an iPad taped to an exercise bike. No offense. I know there's a lot of people who are very evangelical about it, but you have to have that same branding. And the investment banks today are actually sort of demanding that brand recognition.
But wait, I would disagree with you a little bit on something.
Oh,
I'm sorry.
Sorry.
But if you're investing in something that you don't know, you do have to become an expert on that field. And there's plenty of research that you can do in the market in order to get to that point, or surround yourself with experts. But if you go, I would never go blind into anything unless I had concepts down and situations, whether it's biology, chemistry, or whatever. Like batteries were presented here, I know all about batteries. So when this young man that was sitting here next to me presented, I knew everything that he was talking about, and I can distinguish BS from the real deal.
Can you talk about how you approach? Can you talk about how you approach like binary decision making versus kind of like, you talk about real estate deals, like, they're in your circle of comfort. So, I mean, obviously if you're investing in healthcare and pharma, let's say it's a binary decision.
Exactly.
A lot of venture is a binary decision.
It's all binary decisions, right? And what it comes down to is, it comes down to a couple of things. Number one, the cap table. What does the cap table look like? Who are the smart investors in there? Who got in there beforehand? Besides all the other due diligence and things that, that we get into before it gets to the level of where we have to go into really hard due diligence, we want to see who's the cap table, who are the board of advisors, the CEO. It really, all risk is human, right? And if the CEO has a lot of exits, he's navigated many difficult circumstances and different economic forces. That's what you want. We've had an extreme circumstance over the past 3 years with the pandemic. Anyone who's been through that and has been able to bring a company out, I think that is going to be a lot, principally the leadership that we're going to want to invest into, because really what you're investing into in venture is people.
Yeah.
You know, and people get too involved in the idea, and they've been watching too much Shark Tank, and they think that anybody can turn a belt into $1 billion idea. And, you know,
I hate that show.
everybody does it. Everybody does it because it's so disingenuous to the system and
But
how it actually
here's something,
works.
when choosing your investors, when choosing your investment advisory board, do not give them equity right off the bat.
No,
Vest them over a period of time. I do cliff vesting over 3 to 4 years, just to make sure that they are working at least for 3 years dedicated to what we're working on. If they want equity, if they just want to be paid, then I'll treat them like any other consultant in the world. And that's that.
yeah, I mean, I've been awarded options, and you know, they vest over 2 years, so I would agree with you on that.
Give me some equity.
No.
I think that's very helpful, and I think that's what she was getting at. She did clarify a little bit that she was talking about early stage company.
Oh, yeah, okay. That makes sense.
A lot of
Not every dollar is a good dollar.
Yeah.
Yeah, and I think that's where she's coming from, is she may have an early stage company and wants to know how she can stand out when she's raising money.
That's a great question.
That's the
Yeah.
Christine girl. You had an
Yes.
ex-girlfriend named Christine, so I got scared. I bet she was listening.
Oh, boy, that's just gonna ruin the whole night. I spent a lot of time together.
Hey, George, I have another question.
Not X, stop.
There's gonna be more opportunities of like a recession, like probably Wall Street will be laying off more people next year,
Yeah.
so there'll be less coverage in different industries. Do you feel there'll be a lot more opportunities for guys like you who are looking at deals?
I think so.
bigger deals,
I
maybe
think-
better price deals.
I think what's going to happen is that a lot of the investment banks are just going to get rid of it. There's going to be a brain drain somehow. All these people are going to be left out there in the market, and people are going to be like, who's still standing? The people who ran their own balance sheet, the ones who've been careful about it. And it's going to gravitate towards that. And I think what you're going to start to see are cabals of influence, just like anything else, where people come together and they've pulled up and just wrapped up and do these deals together. I think also that it was the families that were the original venture investors going back to the 1600s. And they're going to be the ones today that'll probably prove to show some resilience financially when dark things happen in commercial real estate. Let's face it, we've had 375 basis points over the past, not even year, 8 months. Last time that happened was 94. Look at what happened then.
Yeah, I
So
mean,
there's-
we look at recessions as
Yeah.
opportunities to invest, buy really cheap. Anything that is synergistical with our existing corporations will buy.
Hey, Marco, you invest internationally and the recession is far worse
Yeah,
outside the United States. You know, I mean, you look at Europe, there must be fantastic asset acquisition opportunities in Europe right now or
Mhm.
coming up, right? So.
Yeah, so another company that we're buying into, we're getting into mining, and we didn't do mining for maybe 50 years. Seeing the trends of the whole automobile industry, which we're involved in, lithium is really something that everybody's talking about. So in Portugal, northern Portugal, we bought a company that is going to be exploiting in the mining sector for lithium, because Europe is claiming and wants to be independent of what China has done to the rest of the world with lithium.
Sure.
For batteries. So anything related to batteries, systems for the sector, for the EV sector, especially, where by 2035 in Europe alone, we're expecting 135 EVs, but nobody's asking the question, where are these vehicles being produced?
So the manganese, the cobalt, all those material science.
Yeah, so going back to chemistry 101, when you look at the list of vertical of families, and this is how you have to become an expert,
Yeah.
right? Your metals that are conduits of electricity have different capacities. So you have to look at what those elements are, where they're being produced, and how they can be optimized. Magnesium is definitely one that could be potentially a source rather than lithium.
Also mining in Africa too.
Right, where the lithium has become such an issue. Everything has gone up. Supply lines are slow. Our raw material is 30, 40, 50% up, and it's not going to come down. If you're thinking that's going to go down, there's no way. Cargo, shipping, freight, everything has gone up. And anybody that I know in that business, as a friend, I've asked them even, are you ever gonna lower your price? And then they're looking at me like, are you nuts?
Why?
No, everybody's willing to pay these prices. So it's just the market reset itself to a higher standard or more expensive. So the opportunities are there, right?
Fascinating.
Yes, George.
Okay, so that's very helpful.
I do that. I do that.
No, I'm glad you did. Where in the world is lithium mined? Just
Yeah,
curious.
I said Portugal, northern Portugal is
Oh,
where
so
we
that-
are.
Yeah.
And it's actually, we have a London-based company. Peter is there. Savannah Resources is what we're called. And we're right now probably the leading company exploiting lithium in Europe.
I didn't realize
There's a
that.
lot in China and there's a lot in Africa as well.
They are, but I'm not touching that because my market is Europe and the US, and I know the US also has this issue. Mexico, it's also another source. But you know, the name of the game is you have the money, you pay for it, and then that's how it goes. But there's a lot of government influence where
Right.
our family's name can play a big role as long as our money, right? And that's what the family brand equity that I was talking about plays a big game.
Are you guys looking at blockchain or fintech? I know obviously crypto's had a very hard fall recently, but there are other technologies.
But blockchain, so just to be clear, blockchain is a program that allows you to have better cybersecurity.
Yeah, I mean,
in place.
Well,
Right.
and for example, tokenizing real estate interests, giving fractional interest through the blockchain.
So through the telecom company, we have our own crypto reward system that we're going to be promoting anything that we're producing today. So we're producing motorcycles, bicycles, scooters. We're going to have a car in the market that will be competing with Tesla and Lucid at a higher level, made in Italy. So it has a whole different connotation. I would like for that to become the ecosystem within telecom. So how we're going to push that is to our users that are already connected to our satellite systems. So in our case, we have I think we have 500,000 users right now and ramping up. And this is one of the reasons that we bought this telecom company, because telecom right now is in two different ways you can look at it, whether you own satellites, which needs to be updated constantly through technology, or you have antennas that are creating the 5G, 6G, 7Gs of the world. And in this company, we have both. So it's extremely important to put your hands and position yourself within telecommunications, because this is the way the world communicates today through any devices or any type of net or Wi-Fi connection.
Right.
So this is how you get to your clients.
Right. So as far as just switching gears a little bit, how important is ESG? And I know that's
I'm leaving.
Yeah.
I know
All
that-
right. Thank you very much for coming.
Bye. Thank you, guys.
See you at the bar later for dinner. All right.
but do you see your families thinking about that at all, or not really?
Yes, of course. I mean, from my perspective, I have my son here who's the 5th generation, and I tell him the same story. You know, guy walks down the beach with his son, sees all these starfish dead on the shore, and the son starts throwing them back in the water, and the father says to the kid, "What the hell are you doing? They're all dead. You're not gonna do anything." And the kid says, "Well, I'm not gonna make a difference to all of them, but just to the ones that I'm throwing back in the water." So the way we look at it is that's how we put our grain of salt in the system. I'm not necessarily the ESG king of the world, and I will never call myself that, but maybe I would influence some people to do the same, and that's the way we should all look at it.
Our investors are more interested in impact, meaning, you know, we invest in Tom's company. How many millions of lives can they brag to their friends about that they've impacted post IPO?
Like nightclubs.
Yeah, things like that. You know,
Nightclubs. That's impacting.
but that's impact. As far as ESG, you know, I mean this with all due respect. It seems to be a very politically polarizing thing, especially with families in Southern California that we deal with, and in the Southwest, which tend to run more red. ESG is not something of principal concern to them.
Yeah, have a foundation that you can throw money into to build
Right,
homes for
right.
a bunch of people. We do that.
Yeah,
things
I
like
think, you know, I think, you know, sustainably being impactful is really what these families are looking for. Not the tickle list. Yeah.
That makes sense.
So George, if I jumped in, a couple of things, comments I'd make. First
Sure.
of all, look, I've been investing since the late 80s. Okay. And so if we look at E, S, and G, let's just talk about that. I was trained as a credit analyst and then moved into distressed and others. So it's just part of the toolkit of investing. If your company is not environmentally friendly or sound, or hasn't put together the right assets to cover potential liabilities into the future, that's a problem because that's a huge credit risk. Social, let's take the social out for a second and then go to corporate governance. You're the best company in the world. If corporate governance sucks, it goes bankrupt. So, it's just part of a tool set that has always been embedded in us as fundamentally as analysts when looking at a company. Now you take it, it becomes politicized, et cetera. And there's many potential investors and stuff that LPs, obviously you have to be check their different boxes. I'd rather, instead of focusing that talk right now, what I'd like to focus more on the fact is that a number of real estate class B, class C buildings across Europe, across the US, there's carbon neutrality guidelines, particularly in the EU, that must be attained by 2030. That's 7 years away. Also, not everybody's coming back to work. I don't care how much the cities look, et cetera. There's this hybrid. People don't need the space. And therefore, all these office buildings and some hotels need to be repositioned. And if they're class B, class C type of assets, they're going to be what we call stranded assets. Publicly traded companies will not locate there, and they'll just be sitting there as bankrupt assets. And the value could be put on by CBRE as others as X, and the bid's going to be zero, or a cap rate that just doesn't make any sense. And the bid ask will remain so wide that it just won't trade. And eventually it will trade, and it'll have to be repositioned. And it's not that easy to reposition some of these assets because you can knock a building down and the carbon footprint could be worse than just as it stands right now. So not only are we going through a recession, we're going through a green wave, and that green wave is going to have a significant impact on commercial real estate over the next several years. And there's going to be huge discounts, and there'll be huge opportunities to reposition those assets. So it's a little off from your ESG question, but I think it goes to the fact of how we have gotten to in the US and across the world and focusing on this. Now we're going to be left with a number of assets that are just going to be unusable for quite some time and not have implications for investment opportunities. And that's across the real estate asset class spectrum.
Right.
Be a greenie.
Marty, do we have any other questions from the audience?
No, we've got about 5 more minutes. If you have any more questions on your own there, George, or we can call it. But I think right now, there's no questions from the audience. Anybody in the room here?
Great question.
Excellent question.
That's happening faster than you
Are you
think.
putting money in?
Can-
Yeah.
What do you like? What-
Yeah.
Can you give us some color?
Industrial
you-
real estate. What's going to hold all that stuff? What's going to hold the pharmaceuticals? What's going to hold the chips? What's going to hold Class A industrial?
True. So we just invested in Deerfield, Florida, in an industrial park where we have a manufacturing capacity of 200,000 EV bicycles per year now.
In Deerfield?
Deerfield, made in America bicycles with our brand name on it as of 2023. So yes, it's great. Whether the government is going to give an incentive or not, nothing is happening.
But
with
I
that.
think
And I wouldn't expect anything the government to give me anyway. I mean, we need to spearhead these movements, and then they come after. Like in Portugal, when I was talking at a e-mobility summit, even though all the head of states were there and listening and all that, they asked me the same question: would you take money from the government? I said, no, not now, because even if they're giving me government money, it's not government money, it's taxpayers' money. So I need to really make sure that the taxpayer is well educated in the sector before we can even start behaving like that. And there are companies that are taking advantage of this, and I would probably say to them, the heck, don't do it. Do the right thing, and hopefully we are.
as a real estate guy, I want to be in the path of progress. Where's everything going to be manufactured? Where's it going to be held? right? Look at it. You have the last mile, right? You know, Amazon, you know, you have these trucks and everything. How do we play in that with picks and shovels so that we're not totally, you know, invested into those companies themselves, but rather tangentially through, you know, increased leases, right? And other things that'll happen fortuitously when there's a lot of, you know, and you are seeing a push, and we are involved in a deal right now, a real estate deal, where there is, you know, Pfizer's looking to, you know, lease a lot of space and a few other things too. So these are major multinational corporations that know that there's a big problem, especially with drugs overseas. And it's, you know, becoming even more acute as the days goes on, that they're going to need to, you know, repatriate a lot of that, but that's also going to have capacity, you know, constraints too.
Yeah.
So that's how we would do it. And
But
that's
yeah.
how we intended to do it.
But a government official should really stay out of it. I mean, they messed up the deal with Amazon in New York. They messed up the one with Tesla in California, but you know, where there is a problem, there's a solution, and these companies moved around anyway. So that's why I go back to, I wouldn't even care what the
Yeah.
government is.
I have a question from the audience. What do you think about the lithium ion exchange technology for lithium mining? Any thoughts?
Lithium ion.
Goodwin, can you clarify? You said ion exchange technology?
I think it's for trading, it's just for trading on the lithium itself.
Right.
Trading,
Exchange, yes.
the actual trading. I'm not trading, I'm buying and mining, so I don't really care much about that. Lithium comes in different ways, lithium ion, lithium polymer. It's all about the weight and the autonomy that the battery actually ends up giving you in your vehicles. And it could be an endothermic engine, or it could be an electric vehicle engine. It doesn't really matter. Down the line, what everybody wants to know is electricity really going to be saving me money as opposed to using an endothermic engine where gas prices have gone up? And we don't know
We
this
don't
yet.
know yet. Real science does not yet know.
So we don't know. So it's kind of like a test trial period right now.
Fantastic. Last question.
No, I was just gonna say the example, I spoke on a panel earlier today about making the therapeutics in the United States. This company got $80 million of funding. I'll try to send it to you. It's all DARPA non-dilutive funding, so.
Okay.
It's an example of, it's just, everyone's focused on the chip technology, but there's all technologies, and this has been happening for years, not just because of the pandemic, because of China and the relations and all the challenges from a geopolitical standpoint, so.
So who are we voting for next time?
Marco.
We're not talking
Let's
about
get
that.
political. You're already going there. We're good.